Hey guys, this is John from San Diego Investing School, and Lee has asked me to just put together a few of the ideas I'm looking at right now. And it is Sunday night, January 5th. We've got the S&P futures down 3/4 of a point. We've got gold up $1. Not too much going on. We had a couple interesting days the first 2 days of the year, January 2nd and 3rd, Thursday and Friday. The S&P was down a little bit. I think we're at a critical juncture right now. There's a lot of opportunities all over the place. Um, and Lee wanted me to just mention a few things that I'm looking at and how that's related to the seminar that's coming up. So where we're at right now, this is just a very simple picture of the Dow Industrial Average. You can see this was 2008, we had the peak. 2009, March 9th, we had the bottom. And we've pretty much been straight up with some minor corrections for the last 4 to 5 years. I think this chart kind of speaks for itself as far as what is likely to happen next. This is a much better picture of actually the S&P 500 going back 140 years. And if you look at a typical picture of the S&P, what you usually see is this kind of a parabolic swoop up over time, which is not very useful for analysis. But here what we've done, this is from dshort.com. What's done here is uh, adjustment for inflation. So the prices are not the real prices. They're adjusted for inflation. Something very interesting happens, and that is that you see a very regular uptrend over the last 140 years, and the stock market tends to regress to the mean. It tends to go higher than the mean, then lower than the mean. And what's interesting now is we're currently 77%. Now, this was at the beginning of December. Right now, we're about 80% above the mean. Okay, up here around 1800 actually on the S&P 500. Right now it's 1824.75. And you can see in 2009 how we dipped just below the mean, but then we came back quickly with the stimulus, the QE, the $85 billion, well, $75 billion a month now of bond purchases by the Fed and so forth, the zero interest rate policy. We really bounced back quickly, and we're now, I think, at a critical point. And uh, this is an exception here. This was 2000, the Al Gore information superhighway fraud bubble, basically the Nasdaq frenzy. But aside from that, we have to go back. 2008, we were about 80% overvalued in terms of regression to the mean, and back in the 60s, we were about 55% overvalued. We have to go back to 1929 to see another time when we were, except for this one exception in 2000, we have to go back to 1929 to see a time when we were as overvalued as we are now in terms of regression to the mean. Now, this is just one way to look at it, but I find that interesting. And this is a chart of the Dow Industrial Average in 1929. We actually fell from over 375 in 1929 to below 50 in 1932. 89% drop. Now, I'm not saying we're going to have that happen now, but I do think, as I said, we're at a critical point here. And another thing people are talking about is the price earnings ratio, the PE ratio, and what they're saying is, well, it's only 18. Okay, historical average maybe is something around 16. So we're really not dramatically overvalued, but there's a couple things to remember. First of all, the price earnings ratio itself, the price is what it is. It's obvious. It's the price per share. The denominator of the PE is not the earnings, it's also the earnings per share. And what we have seen recently is this tremendous amount, hundreds of billions of dollars of stock buybacks that have reduced the number of shares outstanding. And so the price earnings ratio is artificially low because when there's fewer shares outstanding, the earnings per share, even if the total earnings of the company don't go up, the earnings per share go way up. And so the PE goes down artificially. Why do they do that? Why do they spend money to buy back shares? Well, one is that most corporate officers, CEOs, chief financial officers, what have you, are compensated not primarily by salary. They're compensated primarily by stock options. And it's to their interest to have their stock price go up. Now, obviously, there's other reasons for allocating the firm's capital in different ways. You could invest in debt, you can invest in equity. But what we have here is an extreme situation. We need to be aware that the price earnings ratio is not as good a valuation indicator as it has historically been. Now, is there something else we can look at which does take into account the balance sheet, the assets, the liabilities, the book value, the cash, and the debt? There's something called the value line, estimated median price appreciation potential of all 1,700 stocks, and they have a hypothesized economic environment 3 to 5 years in the future. Right now, and they look at the balance sheet totally, not just the PE ratio. And that's a total fundamental analysis. And what it's saying now is that number, that projection for 3 to 5 years is only 30%. That's very, very low historically. So what that's saying is on a fundamental basis, we are not fairly valued. We're way overvalued. And that jives with this technical analysis here that says that in terms of regression to the mean, we are way overvalued now. One more thing is, if you remember back in 1987, we had this newfangled notion of something called portfolio insurance, which was really just the idea that you could dynamically hedge your portfolio in a sharp decline by simply selling these newly introduced at that time S&P 500 stock index futures contracts. Well, that didn't work. And the reason it didn't work is once the market started dropping dramatically, there were no buyers. There were very few buyers in the market at any price. So we had a crash. Now, what do we have today that's new? We have trailing stops. Computerized trailing stops now are very, very popular. We have a huge potential avalanche of stops below the market that have followed this price up. And if they start to get triggered, we could have a dramatic drop. So I'm not saying that the stock market is going to decline this week or next week or any time in particular. I'm saying that the potential is there for a big move, and why not position yourself using options to possibly take advantage of some of these opportunities. By the way, if you're not aware of what's going on in the gold market, you probably want to take a look at that too. This shows where we're at right now. We bounced off this double bottom at 1,200. We were $1,800 an ounce a little over a year ago. We've lost about 1/3 of value of the price of gold. Could it go lower here? Yes, it could. But here's a possibility. If we break above this downtrend line, we could have some excitement to the upside here. And for those, I think I have another, yeah. For those of you who look at stochastic divergences or RSI, or in this case MACD, I think there's a divergence here that is pretty exciting to you. That there's an opportunity here in gold. That's another thing I'll probably be talking about the seminar. This is Twitter stock is another thing. If this chart doesn't scream at you opportunity, then you'll probably be interested in coming to the seminar to find out, what you could do with this. But let's get back to the idea of regression to the mean of the S&P 500. We talked about the 2000 exception. At the beginning of December, okay, we're 77% above trend. Here's 2 points. Number one, if we just regress to the mean, to the long-term inflation-adjusted average, the S&P 500 would drop from 1,800 down to 1,005. And you might say, well, John, we're not going to drop that much. But realize, in 2009, we were under 700. Okay? So it's possible. Now, if we decline to a comparable level to previous major bottoms, a tradable long-term buy and hold type of bottom, we'd be down to 450 to 500 range. But I just suggest that here's the link on the web. You can go and read this article for yourself. I think it's a quick read, it's a good read, and he gets into a lot more detail than I have time to do here. But this just shows 1005 would be right about on that mean, that uptrend line, and 500 or so would be a kind of a typical long-term correction like what we had back in 1982. Okay, so I'm already way over time. Let's see, how is SDIS different? Well, we're in person. Okay, there's a lot of stuff you can subscribe to on the internet, newsletters, webinars, and so forth. And I do myself. I spent over $22,000 last year on all these different things and classes and subscriptions and all that, and they're very, very good. They're valuable. But they don't compare, I don't think, to what we offer, which is in person. Okay, we sit down, we go over the fundamentals, we go over the value line, balance sheets, we go over the stock charts, and we go over the comparative percentage yields that are available from different option strategies, and we mastermind on these things, and we make very good use of our time. Okay, it's a very efficient, very fun time to get together and to compare our investing strategies. And we also cover core curriculum and advanced curriculum. I don't have time to go over that right now. I will in the seminar. We also have a proprietary software we've written which uncovers different arbitrage opportunities for option trading. I think I have a slide here for that I'll show in a second. But the other difference, besides the fact that we're in person, we do this in person, is that we sell options. Now, a lot of people, when they go into the option market, they buy options. And most options expire worthless. That's just a statistical fact. And most professional traders who trade options are on the sell side. We are also on the sell side primarily. That's how we make our money most of the time. So that's how we're different. Let me briefly compare our strategy versus a typical buy and hold investor, okay, a passive buy and hold investor. An active San Diego Investing School investor, what does he do differently? Okay, a buy and hold investor buys stock. Active San Diego Investing School investor sells weekly options. That's our bread and butter. That's how we make our income. Buy and hold investor hopes for big gains and fears big losses. We have many small gains, some small losses, no big gains and no big losses. That's just the nature of our strategy. Buy and hold investor needs the market to go up. Our strategy works in an up or a down market. Passive buy and hold investor is really a life of hope and fear. Is that not true? It is true. That's the experience of a buy and hold investor. Ours is, we like to consider it's a life of action and confident patience. Why? Because the action we take is once a week. That's how we have to manage our option portfolio. But as long as we're patient, we can be confident because time is on our side. Those options are decaying in value every day, and that's how we make our income. Now, the biggest buy and hold investor, the most successful buy and hold investor in history, is probably arguably Warren Buffett. In 2001, he had a famous quote, "After all, you only find out who is swimming naked when the tide goes out." Well, the tide might be preparing to go out right now in 2014. We don't know yet, but if it does, are you prepared? Are there ways you know to make money? Number one, to preserve the money you have made, and number two, to actually make more money on the way down. And when I say the way down, if we're going to have a correction in the stock market, it doesn't necessarily have to be a big drop. It could just be a long period of flat, a long period of trading range, a long period of no profits at all for buy and hold investors other than their dividends. And one more thing I wanted to say about the price earnings ratio. Another thing people look at is a price dividend ratio, and they say, well, you know, John, the 10-year T note is only 3%, the 30-year T bond is only 4%, CDs are actually lower than that. At least I'm getting a dividend in my stocks. Well, yeah, the dividend right now on S&P 500 is 1.84%. That's not that great. But if you're in a period of flat market, a flat correction, you can still get your dividends, but you're not going to keep up with inflation. You need to have some other source of income. And what we do is we generate income weekly, and we do it in a limited risk fashion. I don't have time to go into that right now. We will cover that in the seminar. But the thing about the buy and hold investor, you know, Warren Buffett in 2008 was personally worth $62 billion with a B, billion. In 2009, he was worth $37 billion. He lost $25 billion. Now, he can afford to do that, and he got it all back. After 5 years, he kept holding, and the stock market has come back up. He's fine. And by the way, if you want to read this article, here's the link. You can read that article on the internet at Forbes.com. But my point is that most of us cannot afford that kind of drawdown. Okay? When the market takes a big dump, Warren Buffett can afford to take a big hit. But we cannot. We need to keep making money. And by the way, he lost $25 billion of his own money that year. He lost over $200 billion. 200 billion with a B. That's $200,000 million of his investors' money. And the ones that kept holding for the last 5 years, yeah, they got it all back. At least on paper. They haven't sold yet. They haven't locked it in. But some people sold at the bottom. Some people panicked and sold at the bottom. they were hoping